Headline: April retail sales coming in unchanged versus an expectation of a gain of 0.8%. That data follows rising inflation numbers from earlier in the week. Markets lower since Monday. The Dow and S&P currently on pace for their worst week since late January. The Nasdaq likely to see its first 4-week losing streak since the summer of 2019. Joining us now, Jeremy Siegel, finance professor at the University of Pennsylvania's Wharton School. Jeremy, I, with great interest, read your pre-interview notes, and I was really wondering, is he going to say it? Is he going to say the Fed has been, too easy? Is he going to say inflation is definitely a problem? Is he going to say, I've been a long-term bull and I'm finally having some questions? And I'm not going to get any of that from you. And I'll just tell you one thing, Jeremy. Yesterday morning at some of the lows of the Nasdaq, some really well-known investor wouldn't let me say anything on the record, but said that a 23 handle on the QQQ PE for next year is reasonable. And he said that right at the lows, that was not an unreasonable multiple for the Nasdaq next year, saying that this sell-off basically was viable. I think you might agree.
Well, Joe, on our program, I've been very consistent since last summer. The unprecedented monetary expansion, the unprecedented fiscal support, I think excessive, was first going to flow into the financial markets, into the stock market. And then once we reopening and we're right at that cusp, when we heard Gottlieb, it was going to explode into inflation. I've been an inflation worrier, Joe, for the last year almost. The question, and I was the one that said that Jay Powell was the most dovish Fed chairman that I've ever seen, not acting against what is very obviously inflation, and then we're going to have a lot more. So that's going to be a problem down the road. But in the meantime, the money is still flowing in, and I think stocks are still going to be going up.
It seems like you're right. I mean, it's a blessing and a curse. Long term, you keep printing like this, and you think there's got to be a come up. But in the meantime, you're printing, and it's going somewhere. So it's very weird. It seems like a blessing and a curse. But I feel like, remember Chuck Prince said, yeah, we're going to keep doing that. I'm going to keep dancing while the music's playing. But someone can just flip that off in a second, or it doesn't work that way. It's slowly, the volume goes down, and then it finally turns off. Well,
the money supply since the beginning of the pandemic, so we're a little over a year, has gone up almost 30%. Now, that money is not going to disappear. That money's going to find its way into spending and higher prices. Now, not all of it's going to go. We're not going to have 30% inflation. But I predicted here that over the next 2-3 years, we could easily have 20% inflation with this increase in the money supply. Stocks are real assets. They're we call them financial assets because they're traded on exchanges. But the basic value, the cash flows, come from capital. They come from intellectual property. They come from trademarks. Those are real assets. So the money's going to flow there. And, of course, real estate, inflation hedges, and then everything can go up 20%. That money is not disappearing. So that's what we're going to be looking forward to, I think, over the next year. And then the Fed is finally going to be forced to say, yeah, I got to stop this. And, then you're going to be then there's going to be a bump in the road.
The market is a buy in 2021 with another 10 to 20% to go in the lower with not much else. Not much else. Lower return regime.
You don't want to go into bonds. Or cash assets. They're the worst.
And then dividends will be in vogue too, and people will strive for dividends because there will be some inflation, and that helps with that.
Yeah, and that's the only way you can get protected. And we all know on treasuries you're going to get negative real returns. That's already locked in. You go into tips today, minus 1%. That's not something very attractive. When the history is that stocks more than compensate for inflation, and there's a lot of dividend-paying stocks 2, 3, 4, 5%. So why would you go fixed income? I mean, the gap is huge. And that's what I think is going to continue to drive the money into the market, despite the fears that will be realized that the Fed will tighten in the future.
Shepard Smith here. Thanks for watching CNBC on YouTube.